If you've dipped your toes into the world of cryptocurrencies, you've probably come across the terms DEX and CEX, but what do they actually mean? Well, you're about to find it out. Let's break down the differences between decentralized exchanges and centralized exchanges. What is a DEX? Decentralized Exchange is a platform that allows users to trade cryptocurrencies directly with one another without the need for an intermediary like a bank or exchange service. Instead of relying on a centralized authority, DEXs operate on a blockchain, meaning that users retain full control of their funds at all times. Think of it like a peer-to-peer marketplace where buyers and sellers are in direct contact and the transaction happens on the blockchain. Popular examples of DEXs include Uniswap, SushiSwap, and PancakeSwap. One of the biggest advantages of DEX is that they're typically more secure since users control their private keys. However, they can be a bit more complex to use, and the transaction speeds can vary depending on network congestion. What is a CEX? A centralized exchange is the opposite of DEX. On a CEX, users trade cryptocurrencies through a platform that acts as an intermediary, meaning that the exchange itself holds custody of your funds. This is more similar to the traditional stock market, where you trust a broker to handle your assets. Examples of popular CEXs include Binance, Coinbase, and Kraken. These platforms are known for their user-friendly interfaces, fast transaction, and high liquidity. However, they do require you to trust the exchange with your funds, which introduces some level of risk. Since CEXs are centralized, they have a single point for control, which means they can offer better customer support and easier-to-use features. But on the flip side, they can be vulnerable to hacking or regulatory issues. Key differences between DEX and CEX. So, let's summarize the main differences between DEX and CEX. Control. DEX. You control your funds at all times. CEX. The exchange controls your funds. Security. DEX. Higher security because there is no central authority that can be hacked. CEX. While they have strong security measures, you're relying on exchange to protect your funds. Ease of use. DEX. Can be harder for beginners, and you may need to deal with gas fees and liquidity issues. CEX. Easier for beginners with user-friendly interfaces and better customer support. Liquidity. DEX. Liquidity depends on the users, and it can sometimes be lower. CEX. Typically has higher liquidity, making it easier to buy and sell assets quickly. Pros and cons of each. Both DEX and CEXs have their pros and cons, so which one is better depends on what you're looking for. DEX. Pros. Greater privacy, control over funds, and decentralization. Cons. Can be harder to use, lower liquidity, and slower transaction. CEX. Pros. Easier to use, faster transactions, and higher liquidity. Cons. Less privacy, reliance on the exchange for security. In conclusion, whether you choose a DEX or a CEX depends on your personal preferences and what you value the most. If you want full control over your funds and value decentralization, a DEX might be the way to go. But if you prefer an easier, more user-friendly experience with higher liquidity, then a CEX might suit you better. Just remember, both options have their risks, so make sure to do your researches before jumping into either one. And if you need help choosing, don't hesitate to reach out or check out more of our content. Thanks for watching. If you have any questions about DEXs and CEXs or anything else related to crypto, leave them in the comments below. And don't forget to like, share and subscribe for more tips and explanations.